Alright guys, welcome back to another tutorial. So in this video, like I said, we shall be talking about forex trading, what it is, introduction basically. So this is the part 2. My name is Joseph Bombale and this is Trading Archive. We're going to be talking about who, the who in the market. So when we say the who, we mean the participants, which people are actually participating in this market. Remember, market has to have what? Participants. So in this market, we have banks, like the banks, things like Stanbic Bank, the Bank of Uganda. For those of you guys in Uganda, but maybe you'd say, for example, the US, you have the Fed, you know what I mean? The ECB, you know, things like that. The Bank of England, things like that. So the central and commercial banks drive the interbank market and execute large FX volumes. So these guys are more of the liquidity providers. These guys are the ones who are providing you with the money or the you see the money we're saying 9.6 trillion is being traded by bruh. Most of that money is contributed by these guys. These guys are the apex predators when it comes to they literally control where price is going. Basically, that's it. That's it. That's all you should know for now. That the big banks are the players here. They're the top G's here. So basically, take it that the banks are the liquidity providers. Then we have institutions. By institutions, we mean corporations, pension funds, and asset managers trade FX to hedge exposure or settle businesses. Now, these guys are some of them are, you would say, like big, they're like big retail traders basically, but these guys do it at a larger scale. These guys have big money, bro. So they are literally doing what we do, but with heavier money. Some of them, and then some of them are mostly those guys who some of them are mostly those guys I explained in the previous video who hedge against. But if you're not in the previous video, this is episode 2, so you literally need to go back to episode 1 where we started from. So the institutions are basically, like I said, some of them are like Apple, they are hedging against the any given currency to better suit their businesses, you know. So some of them are like that. They're not like directly participating, but they are participating. Yeah. Then we have hedge funds. Hedge funds, these guys are like also the big. They're like the big. They're like big retail traders basically. They also speculate funds, take directional and arbitrary positions, often using leverage. They're like big retail traders. Basically, Kati, for us, what we do is we go on the charts, predict, place a buy or sell order. These guys do the same, just do it at a what? At a bigger level. Let's do it with serious money now. Now, this is the same thing for retail traders. These are individuals, me and you, individuals who access the market via brokers and platforms, trading smaller position sizes. Now, for you with your 0.01, anyway, you with your $10, you're here coming to participate in the market. So for you, a retail trader, it's that individual behind a computer trying to also what? Participate. So for you, access the market via brokers like XNES, FBS, Derive, IC Markets, and platforms like MetaTrader 5, MetaTrader 4, CTrader, which you're going to be seeing in what? In other episodes. Yeah. So well, we shall also be talking about reading a currency pair. Now, when we say reading a currency pair, it shouldn't be much of a bigger deal. Reading a currency pair is basically currencies are always traded in pairs. The price of one currency expressed in terms of another. First currency is the base, the second is the quote. Now, as you can see on this symbol here, the euro against the USD. The euro against the USD. So the quote or the base in this case is the euro. The very first currency before the stroke, or the very first currency that appears in the pair, is what we call the base. Now, the second one is the quote. So now the price you're seeing here, the 1.0850, is basically the price in US dollars equivalent to 1 euro. So the way you would read this statement would be that 1 euro costs this amount of US dollars. So this amount of this is a US dollars being equivalent to 1 euro. So 1 euro is equals to this amount of US dollars. So if that figure rises from where it is right now, let me say you come to the charts and you see it's 1.085 at this point. But then you come back tomorrow and it's 1.1000. What means price has just what? Price the price has increased, which means the euro is gaining strength against the what? Against the dollar, because it now costs more US dollars to buy only 1 euro, which means the euro is strengthening against the US dollar. Yeah, basically that's it. So the quoted price tells you how much of the quote currency is needed to buy 1 unit of the base. In this case, the quoted price tells you how much the in the okay now the quoted price here is the US dollar. The quoted price or the dollar tells you how much of the dollar is needed to buy 1 unit of the euro. A Google fact here. Euro USD alone moved roughly 2.3 trillion per day in 2025, about a fifth of the entire global FX market. Basically, this is one of the most liquid. By liquid, I mean it has a lot of liquidity. What do I mean by liquidity? Liquidity is basically money. It shows you that it has many participants. There are more participants in this market than other markets. I wouldn't say it's the most liquid, but it's one of the most liquid instruments or pairs that you would be a participant or be interested in trading. Yeah, so that's been it. We talked about who who are the participants, and now I've started going into reading a currency pair. So remember the quote, remember the base, and remember these facts. Yeah. Thank you so much. Catch you up in the next video. Always remember to give the thumbs up and comment in the comment section what you have understood or what you have not understood, for me to throw more light on that. Thank you so much. It's been the Trading Archive. Catch you in the next one.